Right, good afternoon, everyone, and a warm welcome to our webinar today. My name is Jeremy, and for those of you that don't know me, I'm a chartered financial planner and one of the directors here at Blue Sky. It's great to see so many of you on the call today. This is the first of a three-part series of webinars that we're doing this spring. Very much appreciate you giving up the time today as well. Before we get stuck into the main event, just a few areas of housekeeping just to be aware of. So the presentation will last about 45 minutes. If you've got any questions, please add them to the Q&A function, not the chat function. We'll pick up some of the questions as we go along, but if we don't manage to get to those questions during the presentation, we'll come back afterwards and try and answer those for you. The webinar is being recorded, and a recording will be added to our website. And you can also find a wealth of information there about pension on divorce and all that good stuff. We'll also be sending a copy of the slides out in a few days' time as well. Finally, we'll be pasting the links to our webinars 2 and 3 to the Q&A function before the end of today's webinar. So I'll pass you over to my colleague Mark in just a second. Most of you will be familiar with Mark, but just a little background on Mark and Blue Sky. And Mark will elaborate on that further when he comes in to do his presentation. So Blue Sky have been assisting family lawyers, mediators, and litigants in persons for over 20 years. Mark is a chartered financial planner, a resolution accredited specialist, and the founder of Blue Sky. So over to you, Mark.
Thank you, Jeremy. I just want to check that I haven't muted myself. Good morning or good afternoon. Thank you, Jeremy, for that introduction, and thank you also to I just want to check that I have unmuted myself. I assume
all is good, Mark. All is good.
Lovely. Thank you very much. Thank you very much. So thank you, Rob and Jeremy, for answering or being available to answer questions in the Q&A box, and I will pause at the end of each section just to check in if there's any questions which would be useful to answer for everybody. Just a couple of extra housekeeping points. At the end of this session, on the last slide, there is a link to just 6 quick questions which we'd like your help with. It's not CPD questions, it's just to say, how did you like the seminar, and is there anything else you wish us to talk about in future sessions? So the agenda today starts with a bit of an introduction to who Blue Sky are and what we do, for those of you who haven't used us before. I'm then briefly going to mention the PAG report and the imminent update to that report. And then in the time available, I'm going to be covering a few of the areas that we found a lot of family lawyers and mediators have been asking us questions on. You'll note that there's a section on the lifetime allowance, which I've crossed through. The lifetime allowance matters, of course, all changed last week. The day after these changes were announced, I gave a talk at a Resolution conference in Bristol, and then the next morning flew off for a week's holiday in Austria. So I haven't had a huge amount of time to change the slides. However, in my defense, I think there's some points which are worth still talking about, because the lifetime allowance issue at the moment hasn't completely gone away. So I wanted to talk about that. So who are Blue Sky? There's the 5 client-facing advisors. As Jeremy said, we are all Resolution members. Rob and I have been through the examinations to become accredited specialists with Resolution. We are a firm of chartered financial planners. We're not actuaries. As the PAG report calls us, we're pension on divorce experts, which is where PODE comes from. As a company, we get over 500 inquiries on pensions and divorce per year. The sorts of questions we typically get are the request to do a single joint expert pension sharing report. It might just be a case discussion to get some direction about whether you actually need a report or not, and if you do need a report, what are the best questions to be asking. We'll get scenarios posted to us, which might be, should I accept the offer from the other side, and what sort of income would that give my client in retirement, all the way through to implementation help when you've got your agreements and they need working through with your client. Our focus in all the work we do is maintaining turnaround times, and that does give us some reason to filter, I guess, some of the queries and inquiries that we get in order that we can maintain turnaround times and offer a good service. And in terms of, well, what we do best and areas where we may need to pause for thought, or that we don't do quite so well. So what we do best is, I think we're particularly, those people who know us are particularly grateful that we can have case discussions with family lawyers or mediators, or indeed, where appropriate, that we'll have meetings with clients sometimes as a 5-way roundtable meeting, really helping to set the scene, raise expectations as to what can be expected, and describe the process that we would take people through. We can help you produce focus letters of instructions, and once we are instructed, I would say this, but we've got a pretty good system that means that our admin department maintain regular updates on the progress of your pension sharing report or the work we're doing, so that you don't feel that your letter of instruction has disappeared into the abyss somewhere. Our feedback is that we give, we produce easy to read pension sharing reports. We're very conscious that we're often generating these for time-starved mediators, lawyers, and judges, and we get to the answer quickly, and will include financial planning aspects or graphs and tables where appropriate and helpful. And as I mentioned before, yes, we can implement, and because we've weaved the pension sharing work into our financial planning business, it can, in some circumstances, be a natural progression to provide as a separate instruction ongoing financial planning advice to either client, whether to rebuild pension funds or what to do with a pension share or money that's being received. What we might not be so good at is the dreaded litigant in person who might phone us up, having done a bit of research on the internet, and tells us what they want to pay us for a pension sharing report and what the answer will be. And our years of experience has meant that we're reasonably good at handling that. We're not a commodity producer of pension sharing reports in the same way that, let's say, some actuarial firms might be. That's why we don't take on all the cases that we do. And in particular, in order to limit the amount of work we do, as I said before, to maintain the service we give, we have decided that we won't do cases, or most cases we won't do where the pension share is likely to result in the internal membership being created on implementation. And that's probably because we feel that there's not much additional financial planning advice we can give around that. And we we think we're better used where a case might need a bit of holistic joined up thinking and some kind of financial advice may be appreciated. And so the ones that in particular we would refer to actuarial services would be the public sector schemes, the uniform services, teachers, NHS, etc. So moving on to PAG, most of you there will no doubt have glanced through PAG. If you haven't, I think from a point of view of pension sharing, it's probably the best place to start. And if you really are hard up for time, then at least read the executive summary on each section of the PAG report. The producers of the PAG report did send out a few months ago a questionnaire to family lawyers and mediators and judges and IFAs that were involved in the business to ask them what they thought of the PAG report and whether there were any omissions or any additional information they thought would be helpful. And indeed, some of the areas I'm going to cover were perhaps prompted by those questionnaire responses. In particular, I've got a little section on ring fencing, so pre and post marital pension accrual, a bit about offsetting, and a lot of people asked about the lifetime allowance, which to a large extent has gone away, but not completely. So I'm just going to talk about cash equivalent values, because certainly over the last year, we've had a lot of questions about the nature of the cash equivalents that you've been collating on behalf of your clients. And it's always difficult to know how to pitch these webinars sometimes, because some of you will be very well aware of different types of pension scheme, and some people may not be. So bear with me if this is obviously this bit is going to teach some people what they already know. So I am going to discuss the different scheme types in brief, but I'm also then going to go on to the fact that CEs in the past 12 months, in particular 12 months or so, have changed quite significantly and quite rapidly. And I'm going to put some context around that. But the key points there are be very careful with old valuations. The general guidance is this for over 12 months, then you really shouldn't be using them. But I must say, in the last 12 months, they've been changing so quickly. In some instances, it may be worth paying some money to get a more up-to-date valuation. And in either instance, one way to make sure that you are implementing as closely as possible to what was recommended in the pension sharing report, do try and get those implementations done very quickly. And very finally, again, I'm sure most of you know this, but never share certainly defined benefit pensions based on their capital values. And I've got an example in a moment just to show, put that into further context. So this is a bit of a simple guide to pension schemes. Defined contribution schemes, otherwise known as personal pension type schemes. You will know when you've seen a pension statement come across your desk that they are generally named. An individual will own their pension pot, have its own policy number. The contributions go into that scheme from either the employee or employer, or if it's a self-employed person, they can pay in up to the annual allowance, which I'll discuss in a while. The valuation is quite simple with defined contribution schemes, because it is typically the number of units times the price per unit. That is generally the case how these pensions are valued. At retirement, you take 25% tax-free cash. The remaining part of the fund is paid to you as a taxable income. Fund will be invested, so one hopes that it will grow over time. Now, funding a defined contribution pension for a basic rate taxpayer, pretty straightforward maths. I'm discussing the maths because there's an example that relates to this in a while. But if an individual makes a contribution of £100, then as a basic rate taxpayer, the revenue will add 25%, or sorry, 20%, an extra £25. If you're a high rate taxpayer, you will get additional tax relief, but not at source. You'll have to claim this through your own tax return. In contrast, defined benefit pension schemes are not owned individually. So everybody in a defined benefit pension scheme or final salary pension will be members of a group scheme. Again, the employer or the employee will be contributing into it. And in retirement, or if you apply for a transfer value, that member, if you like, will be taken out and isolated, and his benefits that he'll get from the scheme will be based on years service and his salary. Now, there's different permutations of that, but essentially his pension will be based on how long he's worked and what his salary was. Sometimes it's final salary or a career average salary. And if he wants to transfer, that person wants to transfer out or is getting divorced, then the scheme actuaries will apportion a value to his benefits based on their own criteria. And just as a throwaway, because it has caused confusion in the past, is that the value that we use for pension sharing purposes and for all purposes really will be the value that the scheme trustees have provided, and it won't be the lifetime allowance valuation, which is a revenue generated valuation. The graph you can see there is from XPS Pension Consultants. They produce a transfer value index, which over the last 12 months or so, you will see a sharp decline on transfer values. Obviously, this is an average of all the schemes that they've dealt with, but it shows how significantly transfer values have fallen over the last year or so. The things that drive these values are a mixture of interest rates, inflation, how the stock market is performing. The scheme actuaries have their own valuation methods, and each scheme will be different. They'll also base it on the longevity of their of the members of the scheme and how well the scheme is funded. Now, we never are never given, and it's their practice not to tell us how they've worked out a CE, and other than spotting large significant errors, it's pretty difficult to challenge the basis, or is, in my experience, impossible to challenge the basis on which a CE has been generated. So it is what it is, but be mindful of how sharply many of these valuations have fallen. And I'm just going back a bit to, I think this example is lifted from the PAG report, actually, just to highlight that CEs can be misleading, certainly between defined benefit schemes and defined contribution schemes. And here we have a husband and wife, both age 60. The wife's got a public sector scheme, the husband's got a Scottish Widows personal pension, and you'll see that the values are, the reported cash equivalents are identical. And they could be excused to, if they came up with the thought that, well, let's just leave things as they are because the values are the same. However, if you did leave things as they are, what you will find is that the wife would receive an index pension of 12,800 and the husband 8,800. So it's just a stark reminder that where a final salary scheme in particular, a DB scheme, is involved, be very wary of the valuation, because they normally will not represent the true value of the benefits which are being paid. Another example that we had a couple of years ago, and this is a copy of the pension statement that we received, showing that this individual had a pension entitlement of nearly £85,000. Now, for those who are astute on the maths, you'll see that the quoted CE of nearly £900,000 was woefully short of what our expectation of what the value should be. Even the revenue based on their criteria would have valued it at 1.7 million, and probably more relevantly is that if you wanted to replace or buy a pension on the open market of £85,000, you'd need a fund of about 3.2 million. Well, this case, as some do occasionally, had dragged on for a couple of years for all sorts of reasons. And despite many phone calls to question the initial value, which was assured to be correct, this scheme, it wasn't an error, but the scheme trustees decided to change the basis on which they valued their members' benefits. And a couple of years later, the revised cash equivalent was 2.2 million. And the point here is, and it's a moving target syndrome, because if we had done the pension share based on the initial valuation, we would have had a very different answer from that with the 2.2 million. How do you get around that? It's quite difficult because, as I say, it is a moving target. We have had cases where people have got on well, that they've agreed to set aside a fund of money or not finally divide their cash or investments until the pension share has been implemented. And then we have been asked to do a rebalance to see whether on implementation the equality of income has been achieved, and if it hasn't, how much cash would have to go from one person to the other to balance up affairs. Now, I'm sure a lot of you are sitting there thinking, well, how could we possibly do this from a legal point of view? And I know that it's probably difficult or maybe even impossible, but we have had cases where people have, between them, got on well enough and understand the principles well enough to appreciate that this needed to happen. Now, I'm just going to move on to offsetting, which is my next topic, but I thought I would just pause for a moment to see if Rob or Jeremy have come up with anything at this stage which is useful to include.
Mark, it's Rob. Can you just super quickly, can you go back to the slide? I think it's the one with the £300,000 in the DB and 300,000 in the DC. I've just got a question that just wanted a bit of clarity as to how one of those 3,000, one of those generates 12.8 and the other one generates 8.8. I wonder if you might just reiterate that slide super quickly. If you're able to.
Well, the 12,800 will be a function of their final salary, perhaps, or an career average salary, and a year's service. It's a function of that, and the 300,000 is the valuation that the scheme actuaries have come up with using their own criteria, whereas the husband, of course, has had to buy an annuity with £300,000, and the index-linked annuities are quite expensive, and therefore you don't get much of an income for your lump sum. And it is, I suppose the simple answer is that because many final salary or DB pension schemes significantly undervalue the benefits, and we see this time and time again. I hope that helps.
I do, whilst you're scrolling on to the next slide, there was a question in relation to just getting the annual statement for a defined contribution pension. Is that going to be sufficient, for example, for our purposes as pension sharing experts? The response I gave live, I don't know if anybody else saw that, was it can be sufficient for the job. My only concern would be if the statement was quite old. So if the statement's a month or two old, that's fine. If it's 11 months old and we've just been through something like 2022 where markets have been all over the place, I think my feeling would be it would be time to get that defined contribution valuation updated. Anyway, back over to you, Mark, if you want to pick up where you're at.
Thank you. Offsetting. This was one of the other question that is regularly debated, and I've got quite a few slides on this because I think it might be helpful to just discuss some of the maths, so pin your ears back. But just to start, obviously offsetting is where one person wants to typically retain the house or preserve their pension, and it's a cash offset against pension benefits. And it's important to remember that asset classes, cash and property and pension funds, are all different asset classes, and possibly very frustratingly for many lawyers and mediators is that each offsetting case is unique, and the circumstances of each case will determine the best method of offsetting that is used. And that's one reason why I would say, look, be very careful with tables. We've rarely seen tables being used correctly, and it's hard to use tables when maybe the method of how a table is produced isn't fully understood. Some people use them very effectively, but I would still say be very careful with tables. I'm referring from the PAG report now, and the PAG report reminds us that offsetting is a big deal because people are often losing significant benefits in exchange for cash. And also that litigation claims are overwhelmingly arise from poorly considered offsetting arrangements. And the reason they give this is that trying to compare very different asset classes is an issue and is complicated, and they would suggest that in those cases, a pension on divorce expert is used in most cases, particularly where the values are significant. Just quickly on using tables, we've seen people using Ogden and Attard Lance, and these are offsetting tables which are being produced in order to help family lawyers. And this was a slide from a webinar that was run, and the case they gave, just to show how to use the tables, and the tables are nestled in a 30-page document as to how to use those tables. And the outcome of this particular case is the offsetting figure to use was either 427,000 or 264,000, and you wouldn't be forgiven to say, well, I'm going to take the average of those, because the warning it comes with is don't simply take the average of the figures. The two figures that were produced here were produced in different ways for different circumstances. So if you have taken the time to read the 30 pages of how to use the tables and come up with those two figures, you then have to understand the basis on how these figures are calculated sufficiently to know which one to apply. And that might be a good time to work with a pension on divorce expert to help you decide which is the right figure that should be used. The reasons for offsetting, again, this is lifted from the PAG report. You'll be familiar that retaining capital, typically a family home or maybe a business premises, is one reason. I'm going to give an answer, I'm going to give an example, but some of the previous slides you will have seen, the question we just had was related to the fact that the CE was a very poor representation of the income, and therefore what you'll see is that the pension share or the pension has been disproportionately reduced by a pension sharing order, and in order to steer away from that, some people will rather part with cash. One party might wish to retain their pension for various reasons, typically if there's something like a commercial property within a SIP, and it might be a commercial property which one party actually runs a business from, that for liquidity purposes and practical purposes they may not want to sell. Overseas pensions are not shareable, so offsetting is often used instead of that. We do see some pretty chunky costs for sharing pensions and implementing them, and that might be a good reason why you use offsetting. And I can't think that this would be excuse me, something that would arise very often, but if the divorce petition was issued before the 1st of December 2000, then that would be a good reason to offset. So I'm going to try and simplify this, and we work with quite a lot of mediators and sometimes litigants in person who we are fortunate enough to have meetings with, and they'll come in, and something which we'll often draw on a whiteboard will help set the scene to how finances, or how their finances will be divided on their divorce. And I'm using this to illustrate some offsetting examples. And initially, of course, the premise is that everything should be divided 50-50. That's the starting premise. I know there are cases where you deviate from it, but stick with the simple example. Obviously, the family matrimonial home and investments are capital, or can be fairly readily exchanged for capital, whereas pensions are a separate matter, and their whole construct is to provide income. And the point with offsetting is that some people will want to retain capital, or some people want to retain income for their own particular personal reasons or practical reasons. And typically what we get asked is, well, if the wife in this example wants to stay in a matrimonial home or have more investments, then the other party would retain more pensions. That's the sort of simple approach. And if we look at an example that, let's say the family matrimonial home has got equity of 500,000, that's 250,000 each. And in my example, the wife would like to keep all the matrimonial home, and therefore she has effectively retained £250,000 of the husband's money. Now, and you'll have to bear with me on this before you jump into the Q&A, if the husband had paid that £250,000. So let's say the wife retains the home, sells it. She's now got £250,000, which she passes to her husband. If he had put it into a personal pension and could put it into a personal pension, it would be grossed up to £312,500. And therefore, in this simple scenario, you could come to the conclusion that retaining £250,000 of cash on one side equates to a pension fund of £312,000 on the other side. There are some issues with this, and the first issue is funding limits. The funding limits may exceed the annual allowance, which changed last week in the budget, so things are a little bit easier, but nonetheless, it might not be practical or possible for that money to be paid into a pension. Do remember that with pension contributions, unused contributions can be carried forward from previous years. If the husband was a higher rate taxpayer and paid that money in a pension, there is additional tax relief to be considered, so that would change the maths a bit. And as a consequence of that, this whole thing might only work, this whole method might only work with smaller offset amounts. Nonetheless, it is one method that can be considered. If we looked at the same situation, but we looked at it in the other way to say, well, the wife wants to retain the house, so she's retained £250,000 of the husband's money. And if she had that cash, and remember, some of this is all sort of done on an academic rather than a practical basis. The question is what indexed income could the wife generate with £250,000? And in this case, if she had £250,000 of cash and didn't put it into a pension, and it didn't go into a pension, but it bought what is called a purchase life annuity, which is an annuity you purchase with non-pension funds. It could give you £7,500 per annum. Now, tax is a slight additional consideration here, but I'm ignoring it for these purposes because I just want to discuss the principle. But in this point, when we did our pension sharing calculations, if this was the case, you could then adjust the pension share so that the husband retained an additional £7,500 of pension funds. Looking at another example, just to make the point, is here we've got a pension sharing case which has been simplified. There's only one scheme that the husband has. The wife doesn't have any schemes, and we haven't considered the state pension here. So here we've got a John Lewis pension scheme. The income payable is £12,000. It's again, it should be noted that in this instance, the cash equivalent is a poor representation of the income which the scheme would pay. We've done our pension sharing calculations and shown that, or concluded that the husband needs to pass 61.5% of his John Lewis pension to his wife in order to produce equal incomes. Now, what you may have noted is, of course, there's some destruction of value here, because if they'd stayed together, they would be sharing £12,000 as a pension. Now they're separate. They have a combined total of £9,230 per annum. The reason for that, I guess, stems back to the fact that the John Lewis scheme were not particularly generous with their cash equivalent. If they had been a bit more generous, there would have been more money in the pot to share, and it would have helped to bring those individual post-share pensions up to nearer the £6,000 mark. If I continue with this example, remember the figure £4,615 per annum. if the husband looked at this and thought, well, I have to give away a lot of my pension, and I lose a lot of income, is there a way around this? So our pension sharing report came up with this, and then the husband comes back to us to say, what if I pay my wife additional cash so that she can generate £4,615 per annum on her own, with the additional cash that I give her? So here we go. The husband has said that he wants to effectively retain that £4,165, and we are going to either do some sort of offsetting against the family home or investments, but that obviously depends on what their personal circumstances are. In this case, I'm going to give 3 methods of offsetting, and there are more ways to offset than the 3 I'm going to discuss with you, but I think the 3 are the easiest methods to convey. I've talked about the offsetting value going into a pension fund and then buying an annuity. That would be method 1. Method 2 is if the cash, instead of going into a pension, bought a purchase life annuity. Or thirdly, and quite differently, because it's a different method, way of offsetting, is if that money was invested so that, and drawn down from, so that the wife could replace that £4,000 per annum from investing the money and drawing the interest and capital. It is important to note here that those first 2 options would provide a guaranteed level of income, which would be similar to that which the John Lewis scheme would provide the husband with. The investment route is quite different, because by the very nature of investment, it is providing an income stream which is not guaranteed. The issues with this are putting money into a pension fund might not be possible because it depends on the annual allowance. There are issues potentially around lifetime allowance protection, which I am going to come on to, and tax relief, whether you're a 20 or 40 or additional rate taxpayer. Purchase life annuities do have a taxation consideration, and under investment, it's not guaranteed. Generally, it's more useful if we can engage with a client to see what attitude to risk they are and what their tax position is, and that's not always practical to do during a pension sharing calculation. So going back to this and reminding you again that this is what we're looking at replacing or buying out. We're looking to buy out one of these incomes in retirement. Is if we look at the maths to generate, or math, I don't know, is it math or maths, to generate £4,600 of gross income, the pension stroke annuity purchase route or purchase life annuity or investment, in order to generate 4,600 of cash, the pension route is 184,000, gives you a gross income that was desired. The net income would be that amount, and you'll have to pause for thought on this, perhaps, or go away and think about this. But if this route was considered, you then got another thought: that does the husband pass the cash to the wife for the wife to put into a pension on her own behalf, or does the husband actually fund a pension himself because he might get higher rate tax relief, and he might be able to have higher funding capacity, and then do 100% share of that scheme to his wife that he's just funded? So that's one route. the purchase life annuity route, which is where you pay a lump sum to get an income for the rest of your life. It does pay net. It would take 123,000 to give a net income of 3,600. And the investment route, well, it depends. It depends on what sort of investment we're talking about and the tax position of it. But suffice to say, depending on what route we took, the investment offset figure would be somewhere between 144 and 180,000 pounds. We've got all sorts of questions there: tax position, what the client's position is, etc. So from this example and the three examples we've given, you've got these range of figures to consider. Now, I guess if you presented these to the client, you might find one person said the big figure and the other person would say the smaller figure. And this is where really it depends on the nature of the case. And the more we know about a case, the more we can help people with guidance as to what we feel is the most appropriate way of dealing with offsetting. Right, I've got a couple of slides on lifetime allowance, just checking in with Rob and Jeremy whether there's any relevant questions at the moment.
Yeah, hi Mark, Jeremy here. So I just wanted to cover off a quick point that was raised by one of our delegates today. Litigants in person. Yes, we are one of the few firms that will deal directly with litigants in person. We get quite a lot of referrals from mediators, and there's some quite good ways that we can work with mediators. You know, for example, we can have three-way calls with the clients, that kind of stuff, and it is a way that perhaps legal fees could be avoided if litigants in person come to us directly to request a pension sharing report. And coming the mediator route often means that, you know, that the people that we speak to are much better versed in terms of what they understand around pension sharing reports, and having a conversation beforehand also gives us the opportunity to set the scene, to raise some of the key points about what a pension sharing report can or can't do. And I think generally speaking, we're relatively comfortable about taking on those instructions. I think the type of litigant in person that we're not so comfortable with working with, and you know, we can't catch all of these ones, unfortunately, is the case where there seems to be, you know, quite a domineering spouse, usually the man, and as Rob mentioned, I think earlier on in the call, you know, wants us to, you know, almost fix the outcome before we even begin. And there's lots of other stories around how clients that don't like the outcome haven't paid us for the work that we do, that kind of stuff. So look, yeah, absolutely, we do work with litigants in person, but we can be a little bit picky sometimes. And yeah, working with mediators is absolutely something that we do. Don't know if you want to add any extra bits to that, Mark, but just wanted to make that clear.
Yeah, no, I think that's captured. I'm also mindful of time, so I'm going to whiz through. I'm going to.
Can I quickly interject? I think it's a nice, easy question. I've got one other. And one quick statement to add to Jeremy's point is that it's not unusual that we might have a mediator that chooses to run a mediation session in our office. Maybe because they like the fact that if there was a financial aspect that came up, they could actually just say, could one of you pop down and provide us some input? So I think that could also occur. But the question I wanted to mention was mentioned by one of our delegates here was if cash equivalents for defined benefit schemes don't always give an accurate picture, do we really need these for DB schemes, or is it better just to look at the statement of benefits showing the pension income and the lump sum at retirement? Any immediate thoughts on that one, Mark?
This is a topic for another session, really, isn't it? But in some cases where all we need to know is the income that's being produced by a final salary scheme, then no, we don't need the CE. But the point is that where we are sharing a scheme, or where there's going to be a share, the CE is the CE that the scheme actuary has produced. It is the physical sum of money they're gonna share. So absolutely, we do need it, and we have to like it or lump it if we think, well, it's not really fair, because that's just the way it is. It's frustrating. I don't mean to sound glib, but you just have to get on, and if it's correct, that's the figure you've got to get on and share.
Yeah, sure.
Right.
Off we go again.
Look, lifetime allowance. I'm going to go through this quickly because I think it's a bit strange. But this is what I would have talked about. I'm going to talk about briefly anyway. The lifetime allowance. That's a history of the lifetime allowance. In particular, each time it has been reduced over previous years. An individual could sign up for protection, what called lifetime allowance protection, meaning that when they took benefits, they could get enhanced benefits which weren't affected or restricted by the lower lifetime allowance level. And I'm going to come back to that. You'll see here the tax revenue was increasing greatly, and recently, until they did away with the lifetime allowance completely, it was frozen, which meant that the tax return, the tax revenue from lifetime allowance tax charge was only ever going to go north. It's a good way of raising revenue. It's one of those slightly under the radar things, and the change that was made, although the headlines were it's going to help us with the NHS and get people back or staying into work, it affects an awful lot of other people. And there's some interesting financial planning discussions we're going to have with some of our existing clients as well. But politically, I won't comment any further. These are the protections which an individual could have had. There's a long list of them. And some of our clients, and I know that some of your clients, still have protection. And the big question is it worth keeping this lifetime allowance protection? Well, I don't have an answer to that. And the reason why I don't have an answer to that is because at the moment, the tax-free cash you can get from a pension is 25%, but it's up to a maximum of 25% of the lifetime allowance, which was slightly over £1 million. So it's 268,000 is the maximum tax-free cash you can get out of a pension. So if someone has lifetime allowance protection from a previous year when the lifetime allowance was higher, they still have the ability to get a higher level of tax-free cash, which could be relevant. And what is really important here is that if you have a lifetime allowance protection certificate, it is valid until you start further pension accrual. And a contribution to a pension fund or joining a pension fund, even if it's non-contributory, will mean you are accruing extra benefits and you have lost your lifetime allowance protection. So there's a real bit of care needed here, because this protection still applies, and you don't want to inadvertently recommend a client starts a pension contribution when they're going to bust this. Now, the government have said they will be wiping the whole lifetime allowance piece out of legislation. Well, until they do, I think we should exercise caution. The other things that came out in the budget was the annual allowance I've referred to before went from 40,000 to 60,000 per annum. That's good news if people are wanting to maximise how much they can get into a pension. And the money purchase annual allowance is basically, if you've got a personal pension, you started taking drawing taxable benefits from, it was 4,000, it's now gone up to 10,000, which means that as a semi-retired working individual, you might be motivated to carry on working so that you can keep funding your pension. Just, I'm going to whiz through ring fencing or apportionment or pre and post marital accrual. First thing to say is that the PAG and more judges just don't support ring fencing. I know that a lot of clients will turn up into our offices and say there's no way they want to give their spouse a share of their pension from before they got married. But because most cases, even what we would perceive as bigger money cases, are based on needs, obviously the court will have jurisdiction to go and supply those needs for the spouse, whether it's within or without the marriage. One of our problems is collating pension data from 20 years ago when the couple got married, and very few people keep a record of their pension benefits. And certainly in the case of defined benefit pensions, our experience is that we haven't come across a trustee yet who can tell us what the member had accrued 20 years ago. So that's a problem. It results in us using a straight line method for dealing with pre and post pension accrual, which I'll come on to. There are also issues with personal pension defined contribution funds, which thankfully most pension providers do or can provide historic valuations. The only issue here, and we see this quite a lot, is if you've got a personal pension which has got multiple transfers in from other pension schemes which have been mopped up over the years, then what you have is a hornet's nest to unpick to find out when the transfers in from other pensions had been accrued, and then you're really delving back into archaic administrative systems of pension companies. So that can be quite a nightmare. But anyway, if we're looking at a defined benefit pension, I mentioned before about the benefits that a final salary pension will give you will be based on how many years service and what your final salary is in this instance. I've made this up, but I've drawn an income profile in the green line. So someone starts work, doesn't earn a lot, gets promoted into management. In their middle career, their career accelerates and plateaus as they reach retirement. And I say I've made this up, but bear with me. So here we've got a person who's got 20 years service. They actually got married 14 years ago, when their salary would have been a lot less. Now, just to illustrate this, the pension payable, the pension that this person would have accrued will basically be the area under the grid, if that makes sense. If referring back to your O-level or GCSE maths, that will be the area under the grid. So what we've got here is that this individual will have accrued this pension benefit up to year 6. The trouble is that when we ask this individual, well, what was their pension, or even what was their salary, because then we might be able to work it out 14 years ago, most people just haven't got an idea. So the answer to that is to draw a straight line, to assume that the pension benefit was accrued over on a linear basis over those 20 years. All well and good. So it's the only real way of doing it, unless you have the figures. But the situation you then have is that actually you're assuming that a much bigger pension had been accrued before marriage than was actually the case. So in this example, the pension you're looking at sharing is actually less than if you actually had the figures. And of course, it could work the other way, but it can be quite a crude tool. And a way around this is to pester clients to say, surely you must have a P60 or something like that going back, or whatever it is, P45, going back, so you can tell us what your salary was when you got married, or even an old pension statement. Not many people do, but it's worth a try. So That's a repetition of a slide just to remind you that although I've talked through ring fencing and lots of people want to have us consider this, it's not something that PAG supports, and we do see judges using and quoting from the PAG report more and more. So a couple of final slides. Where can a financial planner help? Well, I've hopefully articulated that we can work with you and help a lot with initial inquiries, give you a bit of direction. Is there any creative thinking? Could we work with you on a single joint basis or even on a shadow expert basis to help you with the case? We can do pension sharing reports. We can even help decipher other pension sharing reports you might have that you might want some help with, all the way through to implementation. Implementation is always a separate instruction from any single joint expert work we've done. Jeremy referred to our website, and we've got quite an extensive page on downloads, download material for solicitors. One of my parting pieces is this is the Appendix D of the PAG report, where it lists all the qualifications necessary for a pension on divorce expert, and if you are approached by someone who wants to help you with pension sharing work or whatever, you could just refer them to this and talk through, can they tick the relevant qualifications necessary to help you. So there is some help in the PAG report on that. A summary is, do read PAG. CEs change quickly. Consider the impact of this and talk to us about possible solutions. Offsetting's great, but for best results, be specific, gives us context of the case. Steer away from ring fencing as possible. It's a bit of a nightmare. And consider where financial planning input might be helpful, or talk to us about it. We can test scenarios. What would the outcome be if? Sometimes we have clients in the office who want to talk through how their divorce might look in different scenarios, and that can be really reassuring for them and take a huge amount of anxiety out of the whole process. What are the best options in a pension sharing report? And of course, the other side, when we implement a case, whether you're the donor or recipient of a share, lots of people just want to know, well, how is my future, my financial future going to look? Cash flow modelling, I would imagine that Rob or Jeremy in their future sessions are going to talk about how cash flow modelling helps in these cases, which is a real light bulb moment for many clients. Where you can get some assistance, well, PAG report, it's a great book, Survival Guide to Pensions on Divorce. We launched a few months ago, this is a bit of a trial, but a Blue Sky animation. There's links beneath here, and as Jeremy said, you'll be getting copies of these slides. So there's a link here to a quite fast and furious, actually, animation we had done on how pension sharing works. We used it with litigants in person in mind, but we've found some other people have found it very useful. And very finally, let us know what you think. That's the SurveyMonkey link. Maybe if I leave this up here, Rob or Jeremy can type it out and pop it in your chat box or your Q&A thing. So look, thank you very much for listening. I'm really sorry, I have gone over time. I'm going to hang on for Rob and Jeremy to pose any further questions, and do put any further questions you've got in the Q&A box. But thank you very much for listening, and look out for the next one. So Rob and Jeremy, where are we?
Yeah, thanks everybody for turning up today. Hope you all got some good learning from that. Couple of really quick things. I know that maybe this will be on some of your minds where you've instructed a report where there have been lifetime allowance issues. they've been taken into account in the calculations that were done before the bombshell announcement last week. I'm afraid to say that it probably is worth asking the expert to redo the calculations based on what will be the new legislation. Unfortunately, it does mean that there's likely to be additional cost for your clients on that one. But unfortunately, nobody saw this coming. I think the second point about the lifetime allowance as well, as Mark said there, there is some relevance for tax-free cash protection as far as the changes are concerned. So it might well be worthwhile adding a rather generic sentence to your letters of instruction around perhaps, please can you advise if the lifetime allowance has any relevance to this case, that sort of thing. That might be relevant for cases where you've asked some additional questions about equalizing tax-free cash for the parties or something like that. So if you add that kind of generic statement into your letter of instruction, it just gives us the opportunity just to maybe just come up with a few different things there that might be relevant.
And Jeremy, just to butt in there,
yeah.
At the resolution conference last week, we had a small, slightly aborted session on lifetime allowance. But one of the questions asked, and there was a barrister there who answered the question, was that if you had a sealed annex, pension sharing annex, which had been derived from a lifetime allowance case where a lifetime allowance had changed the answer, would this be a BARDA event? And it seems the opinion on the street is that if these cases are in the process of being implemented, this is not, the change in the budget, bizarrely, would not be deemed a BARDA event. So these cases need to be continued with their implementation.
It's a really interesting piece of information, that Mark. So yeah, so be aware, I think is the message there. Just a couple of housekeeping points from me before we go. We really are grateful for you hanging on. I've cut and pasted the invites to webinars 2 and 3 to the chat function, and I've also pasted the SurveyMonkey link as well to the chat function too. So look, it'd be great if you could spare the time to come and dial into our next seminars where hopefully there'll be some really good stuff for you to get your teeth into as well. Any closing points from Mark or Rob?
No, I'm all good, thank you. I only mirror your comments and gratitude for people turning up. But Rob, anything?
No. 2 more exciting webinars to come on similar subjects. That's for sure. Certainly, I think the last one might be quite good because it's all the touch points at which the financial planner might be needed and where they might help. And I seem to recall, Jeremy, you've got some observations, some practical points around pension sharing as well. I think that's your session, isn't it?
Absolutely, lots of exciting stuff around letters of instruction, pension sharing reports, and all that good stuff. So don't miss it. But thanks everybody. I'm now about to close the webinar, and once again, thank you for your time today.
Yeah, thank you, Mark.
Thank you.
Thanks, Mark.